On a joint return, the IRS treats you as one unit. That means joint and several liability. Each spouse can be held responsible for the full tax, interest, and penalties. On the EA exam, they love the "but I didn't earn it" fact pattern. Your job is to spot when spousal relief might apply and which type fits the story. There are 3 high-level grounds for relief from joint liability. Innocent spouse relief is the classic hidden income or bogus deduction situation tied to the other spouse. Separation of liability is for divorced, widowed, or legally separated taxpayers who want the liability split. Equitable relief is the catch-all when the other two don't fit, but it would be unfair to hold the taxpayer liable. Innocent spouse relief is about an understatement of tax on a joint return caused by erroneous items of the other spouse. Think omitted income, like gambling winnings or improper deductions. The requesting spouse is basically saying, "I didn't know, and it's not mine." The form to remember for the exam is Form 8857, Request for Innocent Spouse Relief. Injured spouse is totally different, and the name is the trap. This is not about wrong tax on the return. It's about your refund being taken to pay your spouse's past due debts, like student loans or child support. If you filed jointly, paid tax, or claimed refundable credits, and you're not responsible for the debt, you may be able to get your share back using Form 8379. Now, fix-it tools after filing: refund claims and amended returns. The general rule is the 3-year or 2-year statute. File Form 1040X within 3 years from when the return was filed or 2 years from when the tax was paid, whichever is later. Miss that window and the refund is generally gone, even if the IRS agrees you overpaid. Extensions matter for timing questions. If the taxpayer files an extension and then files the original return by the extended due date, the 3-year period starts on the actual filing date, not the April due date. Also remember, there are special longer windows in narrow cases, like worthless securities, foreign tax, null carrybacks, and certain disaster or military situations. The exam often tests the worthless securities exception. Finally, statutes for the IRS. Assessment versus collection. Assessment is the IRS putting the tax on the books. Generally, it's 3 years after the return is filed, but 6 years if gross income is understated by more than 25%. If no return is filed or the return is fraudulent, the assessment statute never closes. Collection is different. Once assessed, the IRS generally has 10 years to collect, starting from the assessment date. Mateo has a loss from worthless securities. How many years does he have to amend his tax returns in order to take this loss? The options include 2 years, 7 years, 6 years, or 3 years. Think about it. This is one of those special statute exceptions. The answer is 7 years. A refund claim attributable to a loss from worthless securities gets a special 7-year period instead of the normal 3-year or 2-year rule. A tempting wrong answer is 3 years, because that's the general 1040X timing rule, but worthless securities is a tested exception. According to the IRS, which factor does not weigh in favor of approving equitable relief? The choices include abuse by the spouse, poor mental or physical health, the taxpayer still living with the spouse, or none of the above. Think about which one is usually viewed as unfavorable. The answer is the taxpayer still living with the spouse. Continuing to live together generally does not support equitable relief. It's typically an unfavorable factor. A tempting choice is none of the above, because abuse and poor health sound like general hardship facts, but those actually do weigh in favor of approval.